Hi everybody and welcome to this video which is going to talk you through some exchange rate theory. This will be one of two videos in a series which will consider different types of exchange rate system, why you might want to use different types of exchange rate system, but also the impacts on an economy of changes in the value of currency. Right, now anyway, first things first, we have covered some of the basics of exchange rate theory in theme 2. So this is your chance to reflect on what you currently know about this topic. So can you please write down in your books the answer to these 4 different questions here. So define what we mean by an exchange rate. Have a go at defining or explaining the difference between a currency appreciation and a currency depreciation. And then think about what these acronyms SPICE and WIPIDEC actually mean. Think about how changes in currency value will impact on trade performance and therefore economic growth. Right, so hit pause, put down your answers, and when you're happy, please hit play. Right, so exchange rates then. All we're doing here, we are measuring the value of one currency in terms of another currency. So in other words, if you to sell a pound, how many US dollars would you get for that pound? If you sold a pound, how many euros could you get in exchange for that pound? So the value of one currency in terms of another. There are 3 different main exchange rate systems that we need to be aware about. The first one is something called a floating exchange rate. And this is where we allow market forces, so the idea of supply and demand, to influence the value of a currency. Okay, so what we should be happy with are the 2 different keywords, appreciation and depreciation. And you've got some numerical examples on this slide. So a currency appreciation could be caused by an outward shift in the demand for a currency, or it could be caused by an inward shift in the supply curve of that currency. So it's market forces which have forced that currency to become stronger. A depreciating currency by market forces would be caused by demand for the currency moving inwards or supply moving outwards. So a combination of those 2 different changes there, or one or the other, will lead to a currency losing value. So when currencies appreciate and depreciate, it's normally referred to as in a floating exchange rate system, where supply and demand will adjust, and that will dictate the price level of a currency and therefore its exchange rate. We also have the exact opposite of a floating exchange rate system, and that is something we call a fixed exchange rate. And this is where we allow a government or a central bank within an economy to fix the value of its currency. In other words, they don't let it go up or go down. We've got a fixed currency value. So what we might say is Britain, our biggest trading partner is the European Union, and that we therefore might decide that what we're going to do, we're going to fix our currency value against the euro. So we might say £1 is worth €1.20. We're going to fix it in at that level there. It doesn't mean that market force won't still affect the value of that currency, but the idea will be that the economy will use fiscal and monetary policy to manipulate that currency value and keep it at that fixed level. Now, the reason why you might want to fix it is to give people certainty when it comes to international trade and investments overseas. So what we know is that one of the big benefits of globalization is trade creation. If it can remove exchange rate uncertainty, it should lead to more trade taking place between different economies. What you rather than fixing it completely, you might create what we call a peg system. And this will be where you establish an upper value of the currency and a lower value of the currency. So you let it float, but between 2 different levels, an upper limit and a lower limit. I'll show you in a diagram in a few minutes what that really looks like. It's worth noting, everyone, though, that we have 2 new key terms here, a currency revaluation and a currency devaluation. Now, a currency revaluation, the impact is the same as a currency appreciation. The difference is how we get there. So remember, an appreciation is where a currency will gain value or become stronger due to market forces. A revaluation, the currency is getting stronger, but it's because the government have deliberately manipulated that currency value upwards. Now, the reason why you might have done that is to make importing cheaper. If your currency becomes stronger, it could help bring down inflation by reducing the cost of importing foreign goods and services. What you might do instead is to devalue your currency, and this has got the same impact as a currency depreciation. In other words, the currency will lose value, but this way we've deliberately intervened to bring down that currency value. And that could be to improve trade performance by making importing more expensive to take place, or allowing for exports to become more competitive overseas. So we could be fixed, we don't let it change value, but then we can fix it upwards, which would be a revaluation, or we might fix it downwards, which would be a devaluation. A final type of exchange rate system is managed, and that is where the central bank, when they use monetary policy, will potentially influence its currency value by a changing interest rates or money supply. So it's where the central bank are trying to promote some level of stability with the currency. They're going to try and limit its fluctuations upwards and downwards. In other words, limit the size of the appreciation and depreciations, give the currency some level of stability. Now you've got here how you can manipulate currency values. Later on, we're going to be showing how supply and demand changing of a currency will influence its currency value. Here, we've got how government or how a central bank may look to manipulate its currency value. Now, the most simple thing to explain here is the bottom one, interest rate changes. The idea would be that remember what an interest rate is, it's the percentage cost of borrowing or the percentage return made available on investments. Now, if you've got higher interest rates in Britain, it will mean that people across the world will want a slice of that action. So that would lead to more people investing into the UK economy to benefit from them higher interest rates in the UK. So when you raise your own interest rates, more foreign people invest into your economy. Now, to invest in your economy, they've got to demand your currency. So higher interest rates will raise the demand for your currency, and that would lead to a currency revaluation. In other words, the currency getting stronger. If you lowered interest rates, you're reducing the returns available on investments in our economy. And that would have the impact of lowering the demand for your currency, because if interest rates are low, less people want to invest in your economy. So that would lead to the currency devaluing, so becoming weaker. And we can also manipulate currency value, though, through foreign currency transactions. If you operate with a managed or a fixed exchange rate system, the central bank will keep reserves of foreign currency. So you would keep dollars, Chinese yuan, and yen from Japan, etc., euros stocked away in the vaults of your central bank. And then you would buy and sell this foreign currency to manipulate your currency value. So if you want to make your currency stronger, in other words, revalue it, you've got to raise the demand for it. So what you would do, you'll go across the world and you would buy up spare quantities of your currency. So if you wanted to make the pound stronger, the Bank of England go across the world and they would demand pounds in global markets, and they would buy them pounds by selling foreign currency. So selling euros, selling dollars, etc., to demand our currency and raise the value back up. If you wanted to make the currency weaker, what you would do, you would go across the world and you would buy foreign currency. So you'd buy dollars and euros and yen and yuan, etc. And what you're doing to buy that, you are selling your currency. So you're increasing the supply of your own and you're raising the demand for theirs, which would have the impact of pushing down your currency value. You've got here what we call a pegged exchange rate system. And this could be an example of a fixed exchange rate. You've got here the price of American dollars. You've got the demand for their currency and the supply of their currency. Now, under a floating exchange rate system, the equilibrium point where demand meets supply would be the currency value. But what you would do here, you establish an upper limit. So you wouldn't let the currency go beyond this limit here, but you also wouldn't let it fall much below the original equilibrium point. So the idea would be here, you're giving traders a bit of certainty. They know roughly what the currency value will be, and that again could create more trade creation. So for example, if the currency threatened to get too strong, you might decide to lower interest rates to bring the demand down for your currency. If the currency threatened to get too weak, you would raise interest rates and you would buy your currency overseas to raise the demand back up again. Right, everyone, I've just chucked at you there quite a lot of theory. So again, I want you to hit pause and think about these questions and write down the answers, please. So what you should now be able to do is to explain the difference between a fixed, a floating, and a managed exchange rate system. You should also know what a government or a central bank can do to manipulate its currency value. So think about the impact of interest rates and supplies of foreign currency. Explain the difference between a currency depreciation and a devaluation. D, difference between an appreciation and a revaluation. Remember, the outcome's the same, but how we get there is different. And then E, why might you want to manipulate currency value? So you might want to think about why might you want to revalue it? Why might you want to devalue it? You could think about the impacts on terms of trade or trade performance. And then finally, why might you want to fix it? Think about the benefits you would get of certainty by removing exchange rate fluctuations between you and your biggest trading partner. Right, guys, when you're happy, hit play and we'll carry on with the rest of the video, please. What we're now going to do is to be thinking about the different factors which will influence the value of a currency. So we're going to build up to having an equilibrium diagram with supply and demand on it. Right, now you've got here the demand for our currency. So you've got here a normal demand curve with the quantity of pounds on the horizontal axis and the price of pounds in American dollars on the vertical axis. Now, what I'm assuming here is that the only two economies in the world that exist, Britain and America. I'm building up a really, really simple economic model. Now, you've got to think about it. Why will foreign people want to demand our currency? Well, our currency is what we call a derived demand. People demand it because they're demanding other things on the back of it. So to demand UK goods and services, you've got to demand our currency first of all. If you want to make investments into Britain, then you've got to be able to demand our currency to make those investments. Now look what happens, everyone. Imagine we go from £1 equals $1.50 to £1 equals £1. Now what's happened here is the pound has depreciated in value. So it now means that there's going to be an increase in demand for our currency overseas. We're going to get an extension in demand. And think about why. When the pound loses value against the US dollar, American people have got to sacrifice less of their own currency to buy our currency. So think about it. A £1 UK export used to cost an American person $1.50. It will now cost them only $1. So that currency depreciation would raise the demand for UK goods and services. So it would raise the demand for our currency. But also to invest into a UK firm will now become cheaper for American people. So again, that currency depreciation of the pound would raise the demand for our currency. Now, clearly, if the currency went the other way and appreciated, you're going to get a contraction in demand. So if our currency goes in value from £1 equals $1 to £1 equals $1.50, American people are now paying more or sacrificing more of their own money to buy our goods and services. But also investments into the UK will also now become more expensive. So guys, the takeaway points here is when a currency gets weaker, there'll be a growing demand for it, to demand more of that country's goods and to invest more into their economy. If a currency was to get stronger, there's going to be a contraction in the demand for it because buying that country's goods will become more expensive, but also making investments into that economy will also become more expensive to make. You've got your supply. So again, what I'm doing, I'm assuming that we've only got a model with two economies, Britain and America. So you've got here the demand, so the supply of our currency across our world. Now the logic would be this time, if our currency was to get stronger, there would be a growing supply of it. Now think about it, where will that supply come from? It comes from people that currently have those pounds. So if our currency becomes stronger, so it goes from £1 equals $1 to £1 equals $1.50, the cost of buying American goods and services will become cheaper. So we will supply more of our currency to demand American dollars to buy their goods and services. But also investments into America will also become cheaper. So more of us will sell our currency to demand dollars to invest into the American economy. So guys, the idea is as our currency appreciates in value, more of us want to sell it because we can make more money or buy cheaper goods across the world. If our currency was to lose value, then we're going to get a contraction in supply. There's less returns available by investments into America. It's going to cost more to invest into America, but also American goods will also start to become more expensive to buy as well. Right, you've now got this equilibrium diagram. So we would determine the value of a currency by the interaction of supply and demand. So when the demand for our currency equals the supply of it, then we're going to get an equilibrium exchange rate. So in the diagram here, we've set it equal to £1 equals $1.20. Now, clearly, everyone, if the pound had a value above this equilibrium point, then we're going to have an excess supply. There's a bigger supply of our currency than what there is demand, which means more of us want to supply it than what American people want to demand of it. Well, that would clearly push the currency value downwards, and we're going to get a depreciation. If we had a pound value below £1 equals $1.20 on this diagram, we've got an excess demand problem. You've got more people wanting to demand our currency than what we're prepared to supply. The currency would need to appreciate to clear that problem. So guys, when you think about it, when we're at equilibrium point, the demand for our currency is equal to the supply of it. Remember, people demand our currency to buy our goods and services, but also to invest into our economy. We supply our currency to buy foreign goods and services, but to make investments overseas. Now, when you're in equilibrium, your balance of payments must balance. The demand for your currency is equal to the supply of it. Okay, so when you're in equilibrium like this here, the balance of payments should balance. Right, now we're going to go through lots of different factors which will affect currency value. Now, you've got these ideas here, but I'm going to relate all of these to some diagrams instead. Right, now, first of all, we're going to be thinking about what makes a currency get stronger. Now, if I'm showing it through diagrams, it could be demand moving outwards, or it could be supply moving inwards. Let's think about demand moving outwards first of all. Now, think about it again. People demand our currency to make investments in our economy and or to buy our country's goods and services. So the idea is when the demand for our currency moves outwards, investments into the UK become more popular and UK goods and services become more popular across the world. Now think about what could have happened then here. It could just be that the UK economy is doing really, really well. We've got high rates of economic growth, low unemployment, and it's boom time. Well, that could mean that people across the world want a slice of that action, and that would raise the attractiveness of investments into the UK economy to get bigger rates of return at a later date. That would raise the demand for our currency. It could just be that the UK has got higher interest rates. If we're offering higher interest rates compared to other economies across the world, we're offering big rates of return by investments into our country. Well, that would lead to a growth in demand for our currency to invest into our country. It could be our exports are cheaper or more competitive or better quality. That would raise the demand for these goods across the world and therefore lead to the demand moving outwards. A currency can also get stronger due to supply moving inwards. Remember, we supply our money to invest overseas and or to buy foreign goods and services. Well, if investments overseas become less popular and or foreign goods become less popular, less of us will be willing and able to supply our money overseas. Now, what can cause supply to move inwards then? It could just be that other economies across the world are not doing very well. They've got low economic growth or we're uncertain about the future of those economies. So less of us will want to invest into their countries. It could be that interest rates overseas are relatively low. So our interest rates might be higher, which means it's not attractive to make investments overseas. So we will withhold that supply of money in global markets. It could just be that our goods have become more competitive. So our demand for foreign goods and services has fallen. Now, if that happens, less of us become willing and able to supply our currency because we don't want to buy as much foreign currency anymore as what we did do before. Now, if I was thinking about a depreciation or a devaluation, it's the exact opposite. It's demand moving inwards or supply moving outwards or a combination of both. The demand for our currency might move inwards because ultimately British goods are becoming less popular overseas and or less people want to invest into our economy. So this could be that the UK economy is not performing particularly well, There could be low interest rates in the UK, so there's low returns on offer in the UK. Or it could just be that UK products across the world are becoming less popular. Maybe they're higher priced, or maybe we've got declining quality or popularity of our goods, and that will lead to the demand for our currency falling inwards. Less people want it. Supply might move outwards if more of us want to shift our money overseas or want to buy more foreign goods and services. So if other economies offer higher interest rates than ours, or they offer more attractive investment opportunities, we will invest overseas. So we will supply our money to go make those investments overseas. Or it could just be that UK goods are of low quality and higher price. So more of us import. So we sell our currency, supply it overseas to buy foreign currency to buy their goods and services. It's also worth noting, though, everyone, that we've got quantitative easing as a factor. If you increase the supply of your currency through QE, then it could have the impact of pushing down your currency value by raising the supply of it. Right, everyone, now just to end this video, what I would like to do, please, is to think about what will cause a currency appreciation and what will cause a currency depreciation. Think about how you could use supply and demand diagrams to show those impacts on the economy. Right, guys, thank you very much for watching.